just don't know why everybody is so shocked about what's happening. This has been unfolding, and I mean, after all, 2008, that was just a warning. But you have choices in here. How about making the choices that put your best interest first? Coming up. I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in custom strategies. If you don't have one yet, click that Calendly link below. Get yourself on the schedule, get your strategy created and executed as quickly as possible, because this con game is falling down. No doubt about it. Let me just show you what's going on. Number one, do you remember this? Because we talked about it back then. Maybe you weren't a viewer. But back in 2019, wow, the Fed is going to operate in a regime of ample reserve supply. What does that mean? They're backstopping all the banks, but no more reserve requirements. They go to zero. So all of this talk, if you're listening to the talking heads on TV, so shocked that this could possibly happen because, you listen to one guy and they say, well, this isn't a solvency issue. This is a liquidity issue, except for all of the liquidity that's been pumped into the system. Where did all that liquidity go? Bought a whole lot of good stuff, a whole lot of tangibles, I'm telling you right now. But the reserve requirements for your deposits go to zero. How's that make you feel? Does that make you feel safe? Because, hey, they're going to finally, also 2009, finish rewriting the Volcker rule completely. See, under the current rule, regulators presume that positions held for less than 60 days count as proprietary trading unless proven otherwise. But instead, there will now be a series of specific tests to determine which large bank positions count as such. And I get into this much more in part 3, but the Volcker rule was about proprietary trading, which is risky trading, which is speculation. He worries that these restrictions will be declawed if the rule is changed. Yep. When the assets in bank-run funds are tested in a recession, we will find out if the weakened regulation still works. Guess what? It doesn't work, does it? And we're about to find that out in even a much bigger way. So let me tell you, you do whatever you're comfortable with, but it's food, water, energy, security, barterability, wealth preservation, community, and shelter. Get it done. Especially on the money side and the wealth side, for any wealth that you're still choosing to hold inside of this really disgusting system, make sure that you are properly diversified and that you have gold in your portfolio to offset what is really happening inside of not just in the entire Wall Street and Main Street banking system. Because in 2020, this is a statement of Commissioner Allison Herron-Lee on the continued repeal of the Volcker rule. This was, January 30th, 2020. Today's proposal would increase banks' ability to add risk to their balance sheet in 2 significant ways. What are those ways? Today's proposal would increase banks' ability to add risk to their balance sheets in 2 significant ways. It would broaden the categories of private funds in which banks can invest, most notably by including venture capital and credit funds. Wait, venture capitalists. Oh, well, don't worry about them. They were just bailed out in the SVB bank. So they were bailed out 100%, but don't worry about that. And it would allow banks to evade certain investment restrictions by permitting a greater degree of parallel investment alongside covered funds, thus allowing exposures to these often high-risk holdings. Well, isn't that what you want your savings bank to do? Isn't that what you want them to do when you deposit your money for safekeeping? I mean, isn't that what you want them to do? As with the rule last fall, this proposal replaces clear common sense restrictions with just the hope that banks will self-police. God, we heard that. Didn't we hear? Oh yeah, it was Alan Greenspan in the lead up to the crisis in 2007. Don't worry, in 1990, in 2000, he said, don't worry, the banks will self-police. They would never do such a thing. Yeah, right. Okay, just the hope that banks will self-police and remain diligent in identifying and mitigating their own risks, an expectation that flies in the face of experience. The structures of large financial institutions, including bankers' compensation, still strongly incentivize the kind of risk-taking that led to the financial crisis. Hope will not protect investors from bank appetite for risk in the pursuit of yield. I cannot support this proposal, but yet it passed. And what it really does is allow more leverage, which means debt upon debt upon debt upon debt upon debt. They have this teeny little bit of equity, and they have massive amounts of debt tied to it. Yeah, that makes you feel safe. And they can invest in anything they want. So whoop-de-doo. What a shocker that we have another financial crisis on our hands. And this is going to be way bigger, because the Federal Reserve proposes weakening the Volcker rule. The Fed proposed, and you trust them to manage CBDCs, central bank digital currencies? Are you freaking kidding me? You think they have your best interest at heart? Oh, no, no, no. Their job is to keep you calm. Their job is to keep you in the system. Their job is to protect the financial system. In theory, that's to protect you, but they've been transferring your wealth this whole time. You have to vote with your purse. This takes it out of the system. This is the only thing that takes it truly out of the entire system. Then you can go back in when the dust settles. Regulators weakened a section of the rule last year, simplifying the process for determining which types of trading are permitted and which aren't. This is such garbage, I can't stand it. This year, they are proposing to go even further. The proposal would eliminate a 3% cap on ownership of a venture capital fund. It would also allow banks to invest in debt-based funds, among other changes. The objective, said Randall Quarles, the vice chair of the Federal Reserve, is to simplify the Volcker rule. In light of our experience with the rule, over 6 years of implementation, again, garbage. In part one, I showed you they hadn't even finished writing all the laws when they started to dismantle it, let alone actually make banks comply with it. They were very selective in that. The one rule they did not dismantle, by the way, are bail-ins. Except now they have to be choosy with their bail-ins. That's why they bailed out even uninsured depositors, which are what? Oh, a lot of them were venture capitalists. Yay! The Volcker rule was about limiting insured banks' risky trading in an attempt to mimic Glass-Steagall of 1933. But they haven't separated them, which would have been what they did in Glass-Steagall. Just like this garbage. Well, wait, that's a fake real one. Which is the real fake one? Okay, this was designed to mimic real money. Not actually to protect you, because frankly, you've been losing purchasing power since the day you were born. You didn't even realize it. And since they only had 6 years, certainly 6 years of implementation is certainly enough time to know that what they did works. Oh my God, you can't make this stuff up. What about 1929, 1998, and 2008? What about that? 1999 is when they implemented that rule, the Glass-Steagall. Yeah, let's forget about that. The proposed changes would lift restrictions on big banks such as Goldman Sachs and JP Morgan Chase investing in venture capital and other types of funds. And who are we seeing riding into the rescue of other banks that are teetering, smaller banks that are teetering? JP Morgan. And it isn't because they're so good and they just want to help. It's because they want to protect what they have built for themselves. I go into that much more deeply in part 3. If you haven't watched it yet, go and watch it. The effort becomes a decade after risky trading was blamed for contributing to the near collapse of the U.S. financial sector and is part of a sweeping industry deregulation under the Trump administration that has helped boost banks to record profits. Because we all know those record profits, the banks being profitable, the corporations being profitable, that is far more important than the normal guy on the street. But frankly, insanity is doing the same thing over and over again and expecting different results. I don't personally think they're insane. What I do think is that they want this financial crisis. In fact, I know that they need this financial crisis to shift us into a new system. You have a choice today. You could go along and just be swept up in it, where you can make your stand and say, not okay with me. This is my vote. This is my vote. Just a little bit more than a year ago, 2022, and I told you that was going to be a pivotal year. The Board of Governors of the Federal Reserve System, and this is the final rule. The board is amending Reg D, reserve requirements of depository institutions. Don't you remember, in 95, they modified Reg D and created those sweep accounts to give the bank having to pay to hold less in reserves and use your deposits to gamble with. That's the bottom line. They can deny it, but the evidence is right there. Okay, Reg D, yay. The board's action in March 2020 setting all reserve requirement ratios to 0. The increases in the exemption amount and low reserve tranche for 2022 are larger than in previous years, primarily reflecting the one-time effects of the Reg D amendments, because, they have to legalize all of this stuff. And you remember, for those of you that were around in 2008, what they did was disgusting, despicable, evil, vile, horrendous, but nobody went to jail because it was legal. So here they are legalizing all of this garbage, and then we have a crisis. What a shocker. I mean, seriously? Okay. Effects of the Regulation D amendments that eliminated the 6 convenient transfer limit from the definition of a savings deposit and recognized savings deposits as a type of transaction account. Particularly since once they do that, you are a creditor, period. And then the banks can make as many transactions with it as they want. That was just a little bit more than a year ago. Why would they need to do that? It just frees up your savings for more speculation. Makes it easier. They changed the rules. Did you even know it? I guarantee you would have gotten a little something if they send you your statement in the mail, or there would have been a little thing that popped up if you want to know about the changes due. Click here. But if you don't and you continue to use it, then legally you have accepted the change in the terms of your agreement. It's the way they always do it. But, if you think that what happened at SVB is a one-off, which is what they're trying to tell you is a one-off, no, we're going to look at that more. Fed alarms at SVB began more than a year ago as examiners changed and they started flagging problems as it took over. But interestingly enough, one of their predecessors got a new role monitoring Silvergate. We're going to talk more about that in just a second. But this is where the rules were rolled back. See, 2018. And then here in 19 was where they had the ample reserve, and therefore you didn't need to hold reserves. I got your back, the Fed says. And then over here is the weakening of the Volcker rule. And then what really took off after that? All of the gambling without really basically any oversight, minimal oversight. Why didn't they do something about it a year ago when they started flagging problems? I think that's really the question. Now, what's the answer? I don't know. But what I can tell you is if you choose to keep your money in the system, and I get it, you got to keep a certain level in there. You got bill pays, you've got employees, you've got whatever you've got to deal with, but you can always make a deposit. You cannot always make a withdrawal. And if what happened last week doesn't show you that, and them scrambling to insure even uninsured deposits, even foreigners. Yeah, everybody insured. And what are they talking about now? Raising the insurance level. And that is about making you feel calm, not because there's any money there to pay for that, by the way. And I've shown you that as well. You know, you change the Reg D, you change all of these things, and then the experiment blows up in your face. I don't know why you're surprised. Can you see how this was set up? These things don't happen overnight. They happen slowly. They happen below the surface so that you don't see what's really happening. And by the time you do see it, frankly, it's really too late. So the time to get prepared, and we are running out of time. The fuse is already lit. In part 3, I'm showing you what the core of the bomb is and other things. So if you haven't watched that yet, I know I did that one first because I could not keep that information any longer than I absolutely had to. But you definitely, it is buyer beware, baby. It is buyer beware. The result of deregulation and funded with QE money, with interest rates down so low, the central banks forced all of these banks out on the risk spectrum. And they gave them lots and lots of free money with virtually no oversight. So what do you think they did? Do you think they took on a little bit of risk? Sure. Why not? What did they really have to lose? They were getting huge bonuses. They were making huge profits. But this is what I want you to see, because this is SVB Financial Group, but this is a whole list. JP Morgan Chase. This is a whole list of banks. It's not all the banks, but it's all the key banks. There's 100% growth. There's 200. There's 300. Even at 100% growth in just the last 5 years, that is leverage. That is risk-taking. That is putting you in danger and you don't even realize it, because bank relationships are very sticky. I mean, when was the last time you changed your bank, right? They're sticky. You keep it in there. Just like the bail-in, the people that got bailed in Cyprus, you look at that chart. I don't have that graph in here, but I've used it a bunch of times. And the savers stayed in the system and were the ones that got bailed in. Those that were in the know, well, they took advantage of the opportunities and then they left. And they left the savers holding the bag. I don't want you to be left holding the bag. It's disgusting to me. In a twist, the San Francisco Fed's deputy point person in charge of monitoring the bank, SVB Bank, until late 2021, received a new assignment afterwards, becoming the regulator's point person on Silvergate Capital Corp., who also shut this month because of similar flaws in its deposit base and the positioning of its balance sheet. I got news for you. It isn't just in these few banks. They want, oh no, this time is different. No, the banks are so much stronger. If they're so much stronger, why did they bail out uninsured depositors? And why is there now all of this talk of raising the deposit insurance amount and, hey, maybe even backstopping 100% of the deposit? It's to keep you in the system. It's to make you feel safe. But that is all 100% counterparty risk. And any contract, whether it's insurance or anything else, any contract is only as strong as the counterparty to that contract. And if you think that the central banks are that strong, I'm seeing them panic, and this is the only thing that they have left. Because every single time that they tried to raise that rate, guess what happened? It failed. Oops. It was a big, fat fail. That's what happened. And so I'm asking you, and this is something that you have to ask yourself, do you feel safe? Do you think that these banks, these central banks, these government agencies that change the laws, do you really think that they have your best interest at heart? I do not. I have become my own central banker. I hold it. I own it outright because according to the Bank for International Settlements, this is true with this too. But this gold is the only financial asset that runs zero counterparty risk. Zero. But you gotta hold it because it should be pretty clear to you with the events of the last week or so, if you don't hold it, you don't own it. It's just that simple. So part 1 and part 3 are already out because you need to know what the setup is. And I could have made all of them so much longer, but you need to know what the setup is, what's going on. And critically, part 3 is probably the single most important video that I've done yet, period. If you haven't yet, watch last week's Coffee with Lynette interview with Mario and Echo because it was the Bank of England back in September that lit that fuse. And things happen slowly until they happen fast. Did you realize any of this was going to happen over the last couple of weeks? You think everything is just dandy? Because I kind of recall what happened with Bear Stearns and JP Morgan flying in, and I believe that was in March, and everybody go, okay, this is it. It's contained. There's no more problems. There's no more problems. And then, when did you know about it? In September of 2008. The problems had been brewing for a long time. It's like an iceberg, and everything underneath puts you in jeopardy. It's not what you see, it's what you don't see. So again, if you have not set up your strategy yet, click that Calendly link, set up a time to get your strategy developed and executed. It's critically important. And if you haven't already, please make sure you subscribe, leave us a comment, give us a thumbs up, share, because ignorance doesn't make you immune. It just leaves you vulnerable. And I don't like it when you're vulnerable because how many times can you be lied to and you do not know the truth? That's my job. I'm showing you the truth. I suggest you do your own due diligence so that you can believe it. And make some choices that put your best interest first. Because financial shields, they're made of physical gold and physical silver in your possession. Certainly not paper and promises and garbage and lies and lies and lies. Until next we meet, please be safe out there. Bye-bye.